if you could pick one album or song from your youth that totally changed your perspective of the world, what is that song or album and why?
I grew up differently than you guys. I grew up in France. So I've got a song, but it's not going to tell anything to your listeners. But
it's okay.
It's a song by a guy called Nino Ferrer, who sang a song called Le Sud, the South, which is essentially, it's quite a melancholic song about how, how quickly a good life can unravel. And it's essentially a song about France's time in Algeria, and how quickly it unraveled. And it's so I don't know. It left a marking impact on me on how things can go well, and then just a few wrong turns, and somewhat what seemed like a stable equilibrium just goes complete pear-shaped.
Feels like a very French view of the world, by the way.
Yes, exactly. Yeah, if you think things are good, it's about to turn bad.
You're the only person talking positively about China, I'm pretty sure. I don't think we could find another person. And a lot of what you said came true. I mean, just the fact that they've become this dominant exporter, specifically vehicles. And, it looks like their stock market now has obviously had 2 really good years. So I guess the question is the China trade still on? And what other big macro trends do you see right now?
Thanks for having me, guys. And thanks for the kind words. Really appreciate it. Look, the way I conceptualize China, the way you have to understand what's happened and where we are in this cycle, is that everything changed in 2018. And I think we talked about it at the time, but essentially in 2018, the US government blocked China from having access to high-end semiconductors, and the government panicked. The government thought, if they're blocking us from semiconductors today, tomorrow it could be auto parts or chemical products or any number of things. So we have to be self-sufficient in everything. And we have to build independence and resilience in every single industrial vertical line. So the banks were told, no more loans to real estate, no more loans to the consumer, everything has to go to industry. And so for 7 years, literally trillions of dollars of loans went into industry. And 7 years later, we wake up to a world in which China has essentially leapfrogged the West. And now cars is the obvious one. And, as soon as you travel outside the United States, you see all these Chinese cars on the roads, whether it's in Brazil or in South Africa or in Saudi Arabia. You see these cars, you're like, wow, these cars are awesome. And, they're a fraction of the cost of cars anywhere else. And so as soon as you leave the US, you see the cars. But it's not just the cars. China's now producing nuclear power plants for less than half of the cost of the French. I don't know if you saw recently the Indo-Pakistan war that they had. The Chinese jets took down 6 French Rafales. Now, the Chinese jets cost $20 million. The French Rafale cost $120 million. Wow. Indonesia last week canceled their orders for the French Rafales to place an order with China. Now, I highlight this, I'm French. I highlight this with no joy in my voice. I highlight this because when you think of it, like producing cars is hard. I'm not belittling it. Producing good quality cars that people want to buy is not easy. Producing fighter jets is sort of the pinnacle of your industrial, pyramid, right? I mean, producing fighter jets is really top-notch stuff. It's not like, again, I'm not belittling cars, but fighter jets is one more thing above. So bottom line is, after 7 years of pouring money into industry, China is now producing industrial goods, not only cheap industrial goods, they've always done that, but really of high quality standards now. Like, again, fighter jets that can take down French jets. So this is the world that we now live in. And the problem is that China not only can produce all these cheap quality goods, but they're doing it at an unprecedented scale. Like the capacity that they have, and again, people focus on cars, but it's true of industrial robots, of batteries, of solar panels. It's like they can produce so much. And the big question is, where's all this stuff going to go, right? Because right now, you're in a world in which the U.S. is saying, well, it's not coming here. Like, we're closed for Chinese business over here.
I've never seen a Chinese car.
No, and you're not going to see one for a long time. Most likely. You're not going to see, as things look right now, you're not going to see one. Now, it's a shame for you. Right now you can buy the BYD Seagull, which, looks a little bit like a Honda Civic if you want, sort of small hatchback. You can buy the Honda Civic. So sorry, the BYD Seagull. You can buy that in China with the full self-drive mode, which they've now put into every car, for about $8,500.
Wow. What does that mean for Tesla, Louis? Because it seems like
nothing good. It means nothing good.
Yeah.
It means nothing good. And because the self-drive car in China, the mode, forget the car, the self-drive mode is $8,500. And you still have to buy the car. So the point is, you and I wish we could buy those cars for our kids. I mean, I don't know if you have kids, but I have 4 teenagers. I'd be stoked if I could buy them each an $8,000 car that they could, trash and crash, and like you write it off over 5 years, and that's that. But these are the cars that are now being sold in Saudi Arabia, that are now being sold in South Africa, that are now being sold in Chile and Colombia. But it does, we may come back to the question, where's all this stuff going to go? If it's not going to go to the US, it's going to go a little bit into Europe. But here I think China is careful. They know that if they dump too much onto Europe, Europe is going to turn protectionist, and they're going to put up big barriers against them. So really, the main market for all this stuff is really other emerging markets who suddenly get to industrialize on the cheap and on credit, because the only way China can sell all this stuff is by providing trade financing. And so they're providing trade financing. So now, if you're Vietnam, you get to buy subway systems and trains and power plants on the cheap and on credit. Same if you're Indonesia, same if you're Thailand, same if you're all these places. So all these countries can industrialize much faster than they could before. It's actually super, super bullish emerging markets in general. Today, if you're a central bank of an emerging market, you're living in a world in which the US dollar is going down, in which China's providing you a bunch of super cheap stuff. It's allowing you to, improve your electricity grid, improve your transportation grid, et cetera, at a very cheap cost. It's, you're having very low cost of energy, very low cost of food, and China on the back end is stimulating, and so is Europe. If you're the central banker today of South Africa, of Brazil, of Colombia, you've never had it so good. Like, things are awesome right now. It's like Christmas come early. And all these places are going to be able to cut interest rates 100, 200, 300 basis points over the next 12 months. And they will, and they've already started. So wherever you care to look around the world, you find that most emerging markets are now outperforming the US. We spend all day wondering, should I buy NVIDIA? Should I buy Microsoft, et cetera? The reality is that US stocks have now gone nowhere for 6 months for all this, the drama, and all the emerging markets are up 20% year to date. And nobody cares. So this is like the sweet spot right now, where the fundamentals are tremendous, the valuations are attractive, the momentum is strong, the policy support is there, and the investor positioning remains completely non-existent. So it's like it ticks all the boxes. A bull market has started in emerging markets, and nobody cares, which I find awesome. It's like, long may it last.
So I got a question. I know it's not completely germane, but do you see Chinese cars, Chinese airplanes making their way into the U.S. markets? If so, how's that going to happen and when?
The simple answer is Chinese planes, no. Chinese planes, no. Most American
commercial aircraft.
Commercial aircrafts, no. It's just, most American airliners will still buy Boeing. I mean, that's just their pilots are trained for this, etc. It's going to take a generation at least. China right now produces one commercial airliner, and it can't produce them fast enough for its own domestic airlines. They can't keep up with the orders for their own domestic airlines. So it'll take a very long time before China even starts to export the jets. So the planes, like the commercial planes, no. But the cars, I think this is an interesting question, because if you remember on the campaign trail, President Trump kept saying that he wanted BYD to open factories in Michigan, and he wanted Li Autos to open factories in Tennessee,
Right.
and that he wanted like all these Chinese automakers who now clearly have a comparative advantage in producing, high quality electric vehicles. He wanted them to bring over their technology, to bring over their know-how, and to give American jobs. Now, we've seen none of that, of course, in the first 6 months of Trump. So far, all we've seen is really a big deterioration in the U.S.-China relationship, then a sort of walking back the deterioration, and then deteriorating again, and then walking back. There hasn't been any improvement from where we were at the start of the Trump administration. Now, incidentally, this is the one part where China and the U.S. have an easy meeting of minds. Like if Trump really wants BYD to open a factory, Xi Jinping would be very happy to tell BYD, go open a factory over there. It helps our relationship with the U.S. And, I don't care if you don't make money out of it, you're doing it. So I think that part, conceptually it could happen. It's a question of political will on the United States. Is this something that Trump really cares about? And is this something that he's going to push through? During the campaign, it sounded like he would. Now it seems to have fallen by the wayside, but who knows? It could come back.
Well, what are your thoughts on talking about the Magnificent Seven and NVIDIA? It just seems like you're right, that stock has been somewhat sideways for a little bit, but if you look at the revenue growth, you look at the profit margins, it just seems like it's a never-ending demand. Are we getting to a point where at peak demand where, because at some point trees don't grow to the sky. I mean, are we getting to a point where these stocks are peaking out and, we've seen as much as we're going to spend on artificial intelligence, because it just seems like at some point here, it can't go on forever.
So I'm not sure I'm the right guy to ask because I missed the whole NVIDIA thing. So I'm not sure I bring a lot of credibility to the table on this one. What I will say is this, part of the reason I missed it, one of my core beliefs is that, and I use this line all the time, but that when China enters a room, profits walk out. That, competing with China is the worst thing you can do in life. Like if you find yourself, like whatever business you're in, your listeners are in, etc., if they find themselves competing with China, they've taken a wrong turn in their lives. And they need to reassess their situation. Why? Because, China essentially benefits from a very cheap cost of capital. Today, China has the cheapest cost of capital in the world. The government bond yields in China right now are about 1.6% on the 10-year.
That's right. Yeah.
So China has a very cheap cost of capital because it has a massive, massive domestic savings base, number one. And number two, the cost of labor has been going up, but cost of labor is still cheap. But perhaps more importantly, the productivity of labor has improved dramatically in China. Like yes, the cost has gone up, but China now produces more engineers every year than the rest of the Western world combined. So now coming back to your question on NVIDIA, I think the challenge is this. I think in the short term, there's no doubt that NVIDIA is at the top of the pile and they produce chips that nobody else can produce, etc. You also know that the Chinese government is literally throwing billions at this and throwing tens of thousands of engineers at this, at trying to crack this code, trying to essentially produce a domestic NVIDIA. And it seems that every quarter there's new breakthroughs. Like, Huawei is producing better and better chips. And yes, they're struggling to produce them at scale, but, and same story with Xiaomi, who just announced, a 3 nanometer chip. And so the big problem for China at this stage is that a lot of like these guys, Huawei, Xiaomi, they can produce the stuff. They struggle to produce it at scale because they essentially can't get the ASML machines. That's the big choke block, that because of the semiconductor restrictions that the world put on China, that the U.S. put on China, that China struggles to produce a lot of these chips at massive scale. Now, this is where I think there's a sort of Damocles sword over NVIDIA's head, in that if tomorrow there's a great compromise. Like Trump goes to China, meets with Xi Jinping, they get along. China guarantees access to rare earths because the U.S. really need rare earths to replenish all the missiles that are being fired right now in both Ukraine and Israel. And without the rare earths and the magnets, very soon, Lockheed and Raytheon won't be able to produce missiles, which will be problematic. And so if a deal is done tomorrow, I'm just, thinking out loud here, but if a deal is done tomorrow where China essentially guarantees unlimited access to rare earths, even for the armament industry, which right now they said they wouldn't do, even for the armament industry, while at the same time the U.S. removes semiconductor restrictions, then China can start producing a lot of these at massive, massive scale. And then, does NVIDIA still look as sexy? I'm not sure. So bottom line, yes, NVIDIA is really sexy today. Will it still be sexy in 2 or 3 years' time? I think a lot will depend on the geopolitical situation, and a lot will depend on how China's progress on the semiconductor front goes on. But on this last point, I think most people have been surprised by the progress China's made in the past 5 years. So I don't think you can just assume that China will stay 1 or 2 generations behind forever. At least anybody who made that assumption when it came to nuclear energy, who made that assumption when it came to electric vehicles, who made that assumptions when it came to solar panels, to batteries, to you name it, if you assume that China would stay a generation behind, by now you're out of business. So, I would say that to assume that China is going to stay behind in semiconductors is a little bit like a third wedding. It's really the triumph of hope over experience.
Yeah, inevitable.
And we're finding that a lot of our investors are starting to open up to the idea about foreign investing. Now, typically, U.S. investors are really underexposed to foreign investments, especially when you compare the amount of GDP that the U.S. has compared to the rest of the world. And I think especially this year, which you pointed out, international's finally outperforming. I think people are opening their eyes to that. But China specifically, I found a lot of people have a hard time with. There's a whole investing philosophy called ABC, which is anything but China. And we even get clients who say, oh, I'm okay with emerging markets, but please, I don't want any China in there, just specifically because of all the political rhetoric that's going around. And I'm just curious, what you would say to those people who do have concerns specifically with China, not just all of emerging markets.
Look, I'm obviously very familiar with it. I get it all the time. And I think this is, as China's outperformed last year, it was the FXI was the only market that outperformed the S&P last year. It's outperforming against this year. Hong Kong's up like 25% year to date. And you could say, most people don't care, right? It's in an environment where there's other places to make money. Like, this year you've made more money in Brazil than you have in China. You've made
Germany.
I was going to say you made fine money in Europe. Germany, Italy have ripped higher. So, there's, yes, China's done well, but it's like, why do I need to bother with it when there's other places? If ever you get to an environment where China does well and nothing else does, which is, you could say that the odds of that are low and that's not going to happen, etc. This is when, of course, it's going to start being painful. The anything but China attitude is going to be painful. But for now, this hasn't happened, and it may never will happen. If it does happen, though, I think the sort of cheat code will be that you have a number of businesses listed in Hong Kong that are technically not Chinese, but are really Chinese. Think of HSBC Bank, think of Standard Chartered Bank, think of AIA Insurance, think of Prudential Insurance. All these businesses are either American or US, legal companies. They just happen to be listed in Hong Kong and to do most of their business with China. I think in the world of tomorrow, I could easily see a number of investors who've said, I'm doing anything but China, I'm EM X China, I'm Asia X China, I'm World X China, start to accumulate HSBC, start to accumulate AIA, start to accumulate Standard Chartered. Because like this, they say, in their fact sheet, they'll say, I'm 15% England, 15% in the UK, the 15% being 5% HSBC, 5% Prudential, 5% Standard Chartered, no China here, I'm all good. So I think this will be the workaround that a lot. Now, full disclosure, I own a lot of these names personally. I own some of these names. And I own them, I think they're good business and they're growing but I own them partly for this reason, that businesses that are listed in Hong Kong that have an Asia business, that have a China business, but aren't legally Chinese companies, I think will end up trading at a big premium for the very reason you highlight.
Outside of China, where do you see the biggest opportunities in the world? I'm going to assume it's not the U.S.
No, look, I think right now the biggest slam dunk for me is in Latin America.
Okay, why?
For me, well, there's a number of reasons, but the first, I think when we'll look back to 2025, we'll say, what mattered this year, what was really important in 25 was that the U.S. essentially folded its security umbrella. J.D. Vance came to Europe to essentially break up with Europe, right? When he went to Munich. Usually when you break up with someone, you have the decency of saying it's not you, it's me. He very much came in and said it's you. You're a terrible person, and I'm breaking up with you.
Savage.
Yeah, no, he was very, very harsh. I'm not saying he wasn't right or etc. But the bottom line, and same story with President Trump's speech in Riyadh, to be honest, where he essentially told Saudi, the Emiratis, etc. Look, we've done nothing but be trouble for you guys, and we're going to essentially walk out of the Middle East, and we don't need to be here anyway. We're energy producers ourselves. So bottom line, the U.S. is folding its security umbrella, and the biggest beneficiary of this for me in relative terms is Latin America, because the one thing the U.S. is saying is, look, Latin America is ours. The whole of the American continent, you could call it a new Monroe Doctrine, etc. But it's essentially China, you get out of Panama. China, you get out of Venezuela and of Argentina. Latin America's ours. Greenland's ours. Canada's ours. The Americas are ours. And whatever happens in the rest of the world, we don't have to care, because in the Americas, we get all the commodities we need, and we get cheap labor if we need it. So we've got everything right here. Why do we need to bother with the rest of this world and all the headaches that come with it? Now, this means that you get to Liberation Day, when President Trump imposes tariffs on everybody, including the penguins, and you look at you look at Latin America, and Latin America essentially got the flat 10% that everybody got, except that everything they export to the U.S. was deducted, like copper, silver, lithium, you name it, it was taken out. So Latin America is essentially in this new world of ours with tensions everywhere, etc. It's the one part of the world where you have no geopolitical risk. You have super high real rates that are coming down. Look, I'm a commodity bull for a number of reasons. So when commodities do well, Latin America tends to do well. And right now, what you have, if you look at so far this year, it's the best performing region for bonds. It's the best performing region for currencies. It's the best performing region for equities. It's very clearly going through what we like to call a triple merit scenario, which is a period of falling real rates, rising exchange rates, and rising asset prices. And nobody cares. Like literally nobody cares. I can count on one hand the number of clients who in the past 6 months have asked me questions about Brazil, even though like the market's ripping higher. Who've asked me questions about Chile, even though Chile and Peru are over the past 3 years the world's best performing equity markets. Nobody cares. Nobody cares. So I love, again, we look at things through 5 grids, fundamentals, whether the trade makes sense. I think it makes a lot of sense. Momentum, the momentum is strong. Valuations are attractive. Policy support, everywhere. You're about to have elections over the next year in Chile, Colombia, Peru, and finally Brazil. And in every one of these countries, you're going to have leftist governments replaced by center-right governments, which the markets usually likes. So you got policy support. And finally, investor positioning is completely non-existent. So, we can discuss all day about China, but at the end of the day, a lot of people, for a lot of people, it's a bridge too far. They believe China is an enemy and that my capital is at risk there, etc. And to be honest, once people believe that, there's no point in having the discussion, right? If you fear that you're going to lose 100% of your money, then there's, the asymmetry of a trade no longer works. But there's none of that risk in Latin America. Latin America is, for me, it's an absolute slam dunk.
You said you're a commodities bull for a variety of reasons. I'm curious what those reasons are and if there's any specific commodities you like more than others right now.
Yeah, look, well, first and foremost, I think we do live in a world in which the U.S. is saying, look, we're folding back onto the fortress of America. Good luck to you all. We're done securing the world's sea lanes, which essentially, Trump comes in, pummels the Houthis for 3 weeks, spends $1 billion, and then walks away saying, well, we wanted to reopen the Red Sea, but didn't work because we now live in a world of asymmetric warfare. The reality is the days of defending $1 billion ships with $1 million missiles, that no longer works against $10,000 drones. In the age of drones, projecting power away from your borders becomes much more challenging. Now, there's an economic element to this as well, is that if you're the U.S., you have to wonder, why am I protecting the world's sea lanes anymore? For years, the U.S. was selling Caterpillar machines to Indonesia and John Deere tractors to Brazil, but increasingly this business is being taken over by China. When you look at what the U.S. exports, it's increasingly zeros and ones in a computer. It's Microsoft programs, it's Facebook, it's Google, it's Netflix series, it's Taylor Swift songs. And if it moves around, if it's physical goods, it tends to be high value added enough that it moves on a plane, whether iPhones or NVIDIA chips that we were just discussing. Like when you look at what physically moves on a boat in the US, it's increasingly LNG and farming goods. That's it. So if you're the US, you have to start wondering, why am I paying all this money to secure the world's sea lanes so that China can export copper from Africa, transform it into factories in China into electric cars, and then these electric cars are sent to Brazil? What's in it for me? If you're the US. And I think, the bottom line is the US is concluding, actually, there's nothing in it for me. I'm folding back from patrolling the world's oceans, which means fundamentally that, if you're a Korea, if you're a Japan, if you're a Europe, if you're in India, like a lot of these countries historically dependent on the US, for a security backdrop, part of NATO and all that. So there was the security umbrella, but also the guarantee that in a crisis, you'd always get access to commodities. That if tomorrow there's an earthquake or a tsunami or whatever, you could transform your U.S. treasuries into commodities and that the U.S. Navy would make sure that those commodities get delivered to you. Can you still believe that? If you're Japan, if you're Europe, can you still believe that about the future? What we now know, and I say this as a Frenchman, is that when you look at the U.S. administration today, it's no longer the friend it was in the past. That's the simple truth. It no longer is the friend.
Right.
It's a very predatory administration. You saw it with Ukraine. Ukraine comes to Washington and says, hey, we need help. What's the Trump administration's response? What you got for me? What you got for me? You got mineral rights? Fine. We'll take your mineral rights. So it's a completely different relationship. So now the last thing you want, whether you're France, whether you're Germany, whether you're Korea, is to suddenly find yourself dependent on the United States for anything. Because if you're dependent on the US for anything, you're going to pay top dollar for whatever help you need. They're going to, have you over a barrel and they're going to whip you silly. And so the bottom line now, if you're a foreigner, I think is you have no choice but to stockpile commodities in a way that you weren't doing before. You have to, hope for the best, but plan for the worst. So instead of recycling all the excess dollars that you earn in treasuries, which is what you've done for decades, you're increasingly going to recycle them in whatever commodity you're short of, whether those be copper, uranium, or food, or oil. I mean, everybody's, short different things, but whatever you're short, you're going to be stockpiling it from now on.
Hey, hope you're enjoying the most recent episode of the Pain Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We'll go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement. How do you take Social Security? How do you draw from your portfolio, factor in inflation, and don't run out of money? We'll look at diversification. Markets have been wild over the course of the last couple of months. Has your portfolio been up and down? Or have you been sitting in cash, CDs, money market funds, paralysis by analysis? We'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, insurance product, structured product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook, and we'll do this full review at no cost. We'll literally go through everything for you, do all the work up front. Simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review.
Well, you really make it sound like the U.S. is running a protection racket.
Like, the U.S. has been the most generous nation for decades. I think it really has. The reality is, with $37 trillion in debt, with budget deficits of 7% of GDP, the U.S. cannot afford this generosity anymore.
It's a fair point.
It's now, I think, when you listen through the Trump administration, they're desperately trying to find a way to stick the bill to the foreigners. So initially they come up, they say, oh, we're going to sell these $5 million cards and take all of the world's best producers, entrepreneurs, best taxpayers, and we're going to bring them here in the U.S., which is quite a predatory thing to do. It's like, who pays high taxes in your country? We'll have them, please. And obviously very few people take them up on it, because the reality is, unless you're Chinese, unless you're Russian, if you have a lot of money, you could already move to the U.S. Like, I'm French. Like, I can move to the U.S. tomorrow. There's plans. You invest money, etc. I don't need to spend $5 million to move to the U.S. And more importantly, if you're very wealthy, you actually don't really want to pay U.S. taxes, because it's not like U.S. taxes are low. If
Fair
you're
point.
very wealthy, you can live in Italy. Right now, if you're not Italian, you can move to Italy, pay 200,000 euros a year, live in Milan, a flat fee, boom, you're done. So if you're a billionaire, Milan's not a bad place to live. Good food, international airport, great opera. It's like an hour away from skiing. There's worse places to live. Anyway, so first thing they do, $5 million. Then it's like, oh, we'll do the tariffs. Then it's like, oh, Prop 899, and we're going to be, charging foreigners for the right to invest here. We're going to charge them income tax on their incomes that they make here. Now, the problem, if you're a foreigner, is full well that this will be the easiest tax in the world to increase. Right? It's like, you start low, and tomorrow it's like, oh, you know what? We need more money. Let's charge the foreigner some more. I mean, that's the one part that doesn't vote. So it's funny, because you're creating a tax that goes very much against the very founding principle of the United States, which is no taxation without representation.
But it's in the courts right now, in all fairness.
No, it is, and it might. We'll see where it goes. But the bottom line right now, I think, if you're a foreigner, is you're thinking, they're trying to pick my pocket. Like, they're trying to find a way left or right. And so what I'm hearing from every pension fund in the world, every contact I have everywhere, is nobody has sold the U.S. yet, but nobody's adding. And just the fact that nobody's adding means the U.S. dollar goes down, because the U.S. runs massive twin deficits, 11, 12% of GDP. And if foreigners don't buy, then, the natural progression is for it to go down, for the dollar to go down. If so, the big question for me for the coming year is, A, do foreigners come back, and what brings them back against when you look at an administration that feels quite predatory, do foreigners come back, or do they start to leave? And if they start to leave, then the dollar really starts to go down.
Well, the other problem with that too is the American exceptionalism trade, right? How much money was funneled to the US just to buy 7 stocks. And if some point you get some underperformance there, I mean, you're talking about worldwide money that can potentially sell out of that and convert back to their own currency. And I think you saw a little bit of that earlier this year, right? I think a lot of that was the fact that we saw that trade unwind, right? We saw the Mag 7 down, whatever it was, 20% plus. And I think a lot of that, why the dollar went down, is because money was funneling back to other countries that's been in that trade.
Yeah, I think that's right. I think the big challenge when you talk to people who run pension funds in Europe and people who run pension funds in Singapore and in Canada, where I'm calling you from today, everybody tells you the same story: is, you know what? Yeah, I feel the U.S. is more predatory. Yeah, I worry that they're going to pick my pocket, but I've got nothing to buy at home. That's like the constant refrain. It's like, there's my market is my domestic market. I want to bring money home, but there's nothing for me to buy here. My domestic market's too small, and et cetera, et cetera. And I mean, and the smaller countries, like, if you're Singapore, if you're UAE, there's no doubt that, if you're the Abu Dhabi Investment Authority, you can bring your money home. There's nothing for you to buy in the UAE. And to be honest, same if you're Temasek or if you're the GIC and you're managing hundreds of billions of dollars. But think of the Canadian pension funds, your big eights, the KES and the BCIMC and, like the big eights in Canada, together manage more than $4 trillion US dollars, roughly half of which is, in the US and either liquid and liquid investments. And they'll be the first to tell you there's not enough for us to buy at home. But this is where it gets interesting, is if you look at Germany, the new chancellor in Germany was head of BlackRock for Europe for 6 years. If you look at the new prime minister in Canada, he's a former Goldman banker. Now, I might be wrong on this, but I tend to believe that you can take the guy out of Goldman. You're never going to take Goldman out of the guy. So you now have a Goldman investment banker, and you got the pension funds telling him, we want more stuff to buy. He's got a debt situation, and he needs, for geopolitical reasons, to reduce his dependency on the U.S., which means building new LNG terminals, building new pipelines. Like, could deals be made here? Could you create public-private partnerships, infrastructure bonds? I think it's going to happen. I think the first deal that happens in Canada is they're going to privatize the airports. The pension funds are going to be all over it, and this will be sort of a bell ringing off in the market, saying, actually, maybe there are things we can buy outside the U.S. And we'll see the same thing in Europe, where, if in Europe you think I can't depend on the U.S. as much as I used to, the first thing you have to do is massively improve your grid, improve your transportation infrastructure. This is very true for Germany, but it's true for, to be honest, most of Europe, where we've sort of fallen back. For 10 years, we essentially invested in the wrong stuff when it came to energy. We did too much solar, too much wind. It's been a dud. And we need to invest massively into improving our grids and making them more resilient, more independent. I.e., that's more hydro, more nuclear, more coal, more natural gas. We're going to do all this, and it's going to get funded by the big pension funds. And all of a sudden, those guys won't need to buy Microsoft and Google anymore. They'll have other things to buy.
I mean, is that one of the reasons why Germany's market's up 30% this year? It's just they're starting to spend infrastructure spending, defense spending. It's just you're starting to see Europe finally spend on their economy. Do you think that's one of the reasons why you're getting this forward-looking, I guess, move in the European markets?
I think to your point, Ryan, they're saying they're going to do it. They haven't really done it yet. They're saying they're going to do it, but I think they will do it. I'm not belittling it. Again, like the new chancellor of Germany was head of BlackRock for 6 years. Now, what are the odds that a former head of BlackRock can put together some infrastructure bonds and some public-private partnerships and manages to flog it to the head of all the pension funds that he knows well, because he flogged them product for a decade as head of BlackRock? Like, he knows all these guys. These are guys that he went golfing with for 10 years. So how hard is it for him to pick up his phone, say, hey, we've structured this thing. You're in for 100 million euros. And, that's that. Done. And then pick up the phone. Next guy, you're also in for 100 million euros. Like, it's going to happen.
One of the things that you've talked about is that it's a change in the governments in Latin America? Why is everybody going right, moderate right, as opposed to left? It's because of the success of Argentina, or is it just it's a cycle?
I think part of it, you've had two massive successes in Latin America in the past few years. You just mentioned Argentina. The other one is Salvador, right? El Salvador, remember, used to be pretty much a failed state for all intents and purposes, like highest crime rate in the world. And, it was run by gangs, etc. And credit where credit is due. Bukele's done a smashing job. And yes, Argentina's done a smashing job. So I think if you're a voter in Brazil, if you're a voter in Chile, if you're a voter in Colombia, you look at these things and say, hey, I want some of that. I want some of this action. They've had stock markets ripping higher. They've had stronger currencies, etc. Like, that sounds pretty good. I'll have me some of that. So I think that's part of it. I think there's also a factor that perhaps we underestimate in the West, but that amongst the many reforms that Pinochet did after his coup in Chile, is he privatized the pension funds, and it essentially created, private pension funds, and people, you put money in every month, a bit like your 401k, and it's tax free, and you can decide on your allocations. You can decide on, I want more equity, I want more debt, I want more cash. And the pension funds run these monies, and these pension funds are now like really big. Like, Chile's got hundreds of billions in AUM, and Peru's got hundreds of billions, and Colombia's got hundreds of billions. So these things are now sizable. So you've sort of created within the country, everybody's got, like, you've created an equity culture, it's essentially. And very often, that tilts towards the right. Like, if you create an equity culture, people tend to tilt more towards the right. Not always, but somewhat. So anyways, I think that's also a driver.
Is that just in Chile where they have these private pensions?
So Chile was the first one. Chile was the first one to do it. And the Chilean pension fund system is the biggest. And then Peru, seeing the success of it, went down the same path. And so Chile started first, so they got the biggest, then Peru, then Colombia, and Ecuador started late, and so there's a tiny one, but Costa Rica now has essentially the same system. Panama started it, so it sort of spread. Like, everybody's looked at this and said, okay, this works well, and so more and more countries are essentially, going down this route. But yes, the very biggest one are Chile, then Peru, then Colombia.
See, that was always one of my pet theories about, why the U.S. outperformed for so long since I got into the business.
Is the 401ks?
And it was 401ks. Yeah, we had a 401k put, right? Everybody voluntarily putting money in. You're going to have that buying pressure, and I think it's a brilliant idea.
Look, you're 100% right, and I would say that is part of the U.S. exceptionalism. It is, for me, it's an integral part of the U.S. exceptionalism. What has shifted, I think, in the past decade is the extent to which all this money is now going into index fund. And this is why, we mentioned the Max 7, but actually, if you look at the past few years, it's not so much the Max 7 as essentially the top 40 market caps, because Walmart has crushed it, and Costco has crushed it, and Eli Lilly and JP Morgan, and, it's essentially the top, and Visa and MasterCard. It's like the top 40 market caps. They just get passive buying almost day in, day out. And to the extent that these guys can turn around or generate enough positive cash flows that they can turn around and buy back shares and shrink their share count, the effect becomes like massively, massively positive, right? It's, you've got this constant buying, and if at the same time you shrink the share count, it's extremely, extremely potent. And by the way, I mentioned how Chile and Peru were the best performing markets over the past 3 years and 5 years, and nobody knows, nobody cares. It's perhaps not a coincidence. It's the same effect.
How about that? Yeah.
It's the same effect of, sort of just buy the index, and then the biggest market cap go up the most, because actually on a float related basis, like between the ratio of float relative to inflows, the inflows are much bigger. So you're absolutely right. So this works great as long as you're got positive demographics, because it can work the other way. Once, like, if your demographics start deteriorating and people start selling to, because they're retiring and they want to go to Florida on holiday or whatever, then it goes the other way, right? Once your demographics start to go.
That's what everybody thought. But, with, like, in the U.S., my fellow baby boomers and I, we control half the net worth, right? We have $80 trillion. And one of my arguments is that we've had a booming economy because baby boomers are spending like they're never going to die, right? We're traveling, we're spending money on restaurants, we're stressing out the healthcare system. So everybody thought, wow, when this baby boom generation hits 65, the markets are going to be done. I mean, people sold me funds for years on that thesis, and it turned out to be the opposite. So who knows? Hopefully that's not how it works.
Well, look at you. You're still working.
Yes.
I work with two boomers. My two business partners, Charles and Anatole, my two founding business partners. They're both boomers. So I think there is some element of, as you move to a service industry, maybe the boomer retirement isn't as big a factor, because some of them just keep working because they like it and they like being useful, and they like the money. So there's that one element. But the second element, in the US, you still have positive demographics. Like, even if the boomers retire, you still have positive demographics. If you look at Japan, for example, where there it's been much more challenging in the markets.
What about China then? Because China has terrible demographics.
China's terrible demographic. Well, the whole of East Asia is terrible demographics. Like, Korea is the worst of them all. Taiwan's terrible. China's terrible. It's linked to a lot of things. But I think primarily the number one thing is, and I think that's what partly sets the U.S. apart. It's another part of U.S. exceptionalism. It's the size of what people live in. The thing is, if you're a smart kid, you go to Beijing University, you meet another smart kid who goes to Beijing University, you get married, you're going to stay living in Beijing, and you're never going to live in that big an apartment. And so if you live in a 1,000 square foot apartment, you're never going to have 5 kids. What's unique about the US is that you're a smart kid, you go to Columbia, you meet another smart kid, you live in New York for a few years, then you start having kids and you move out to the suburbs. Or at least a lot of people do. And once you're in the suburb, you're living in a 4,000 square foot house with a 1,000 square foot garage, which allows you to accumulate a bunch of stuff. You can buy the kayak and the motorbikes and the snowmobiles and whatever else, and you can have like as many kids as you want. You end up both with very strong consumption and with kids, none of which happens if you live in Japan and China and Taiwan and Korea, because you're living in small apartments, so you can't consume that much, or at least not goods. You can consume services, not goods, and you can't have kids, or you can't have that many.
See, that's American exceptionalism right there. We buy the big house, we buy all the toys.
That's right. It is. Like, but you guys
we
do
just
that.
consume better. We consume better. That's our talent here, Louis.
You do it better than everybody, and it's a lot of it. America has a true culture of suburbia that I know that people make fun of and etc. I think the culture of suburbia is a tremendous support to U.S. growth. And the U.S. is kind of unique of having that culture of suburbia. Okay, Canada has it as well, but Europe doesn't have it and Asia doesn't have it.
At what point, when these strategists cave, I mean, how much money can move towards the emerging markets that's not there now? I mean, it's since everybody's either equal weight or underweight, what happens? They go to an overweight.
So I think this is an important question because a lot of these markets aren't that big, and so a tiny bit of money moving in can have a disproportionate impact.
Great point.
Right. So now, to be honest, I think, again, you look at since the start of the year, most of these EMs are doing quite well. And again, it's not hitting the front cover of the Wall Street Journal or the FT or Barron's or anywhere. So we're still in the early innings, I think, of an EM bull market. What I particularly like is the fact that EM debt markets are absolutely crushing developed bond markets, like absolutely crushing it. If you look, on a 1 year, 3 year, 5 year, 10-year basis, Chinese bonds, Indonesian bonds, Indian bonds, Brazilian bonds, they're all outperforming Western bonds.
Is that just because the yields were higher and now rates are coming down? Is it that confluence that's driving those returns?
So the first part was the yields were higher. You're absolutely right. Now it's increasingly a currency thing. I mean, Chinese yields are 1.6%. U.S. yields are 4.5%. But the view is, okay, maybe the renminbi goes up from here. Look at Taiwan. The Taiwanese dollar went up 11% in 3 sessions. The Korean won went up 7% in 3 sessions. If you were sitting in Taiwanese bonds or Korean bonds, you were laughing that day. So the bottom line is the debt markets are moving in the right direction, and that's a huge support for all asset prices. When bond yields come down, when the currency gets stronger, it's a support for equity prices, it's support for real estate prices, it's a support for economic activity in general. Look, I think to answer your question, Bob, I think by the time all the Wall Street strategists, et cetera, say overweight emerging markets, we'll already be much higher. Like if you're waiting for that point, you'll have missed a good half of the move, if not more. Because by the time they say it and people start to do it, there'll be no sellers. There'll be no. So I think by the time, I'll tell you when they do it, actually, because this is in my first EM cycle. They'll do it when the IPO cycle starts anew in all these markets. This is, when all our favorite investment banks have to place a bunch of paper from Brazil, a bunch of paper from South Africa, a bunch of paper from China. They'll say, actually, China's fine. China's good now. And forget anything but China. These are awesome companies and you're buying them cheap. Here's a bunch of paper that you guys should buy. Now, in my career, each time you get a big IPO cycle in emerging markets, it's not the top. It's usually about 18 months to 2 years before the top. But that's the sign that you want to start thinking, okay, where else should I diversify?
Well, it always just amazes me that there's truly no institutional memory in the markets. We had the tech bubble burst in 2000, and then you had 10 years before people even broke even. And when we launched Payne Capital in 2008, we couldn't get anybody to buy U.S. stocks. Like, no, U.S. stocks, they're terrible. We want to be all in emerging markets. I mean, and now it's absolutely the complete inverse, completely. If that's not a buy signal, I don't know what is.
Not enough boomers in the market left. The problem, there's no institutional memory because, look, most decision makers have been in the market 10 to 15 years.
Great point. Well, I think that's what's going on with like Bitcoin, these cryptocurrencies, is you have Gen Z and millennials, which never been through a credit crunch. So they have no idea when the liquidity dries up what that looks like.
That's right. You're absolutely right. Like you have people who remember 2008, you have people who remember 2000, you have people who remember the tequila crisis of 95 and the Asian crisis of 97. Then you have the people who don't, who haven't gone through something like that. Like for a lot of people, if you've been in the market for 10 years, your defining moment was COVID, where the market like tanked, whatever it was, 35% in a week and came roaring back. And so
child's play versus the great financial crisis, Louis.
No. Of course, it was just a bad week. It was a bad week. If you hung on, it wasn't like I started my career during the Asian crisis. Well, I started really during the tequila crisis, but my defining moment for me was the Asian crisis. And during there was a stretch. The Indonesian rupiah was going down 10% a day every day for 2 weeks. It ended up going down 92%. So you were having to recalculate, every one of your models and everything every day. So the bottom line, like, I don't want to spread like battle wounds and old warrior tales. But I think we have to remember most people, in the markets have 10, 15 years experience. And for them, if you have 10 years experience, the defining moment was the COVID crisis. That was the most important moment in your career.
Most of our clients are obviously mostly U.S. citizens, so they're U.S. centric in their thinking. It's almost as if you're an investor, if you're going to lose money, you want to lose it in your own country. You don't want to lose it in somebody else's country.
Yeah, for sure.
Right?
You always think like, I remember, so one of our very first clients was a gentleman who's unfortunately passed away, but a gentleman called Bill Stewart, who founded a firm called WP Stewart. They were big growth investors, terrific firm, terrific people. And I remember, this is early on in my career, there was like some kind of big blow up in the Hungarian debt market, right? Like something pretty and pretty like esoteric. And I remember him telling me, we're discussing, and he goes, "Can you imagine coming home to your wife and saying, 'Sweetheart, I blew up on the Hungarian debt market'?" She'd be like, "What the hell? Why are we there?" And you're absolutely right. Like, there's nothing wrong with, say, taking a loss on Procter and Gamble or on Microsoft, or it's like nobody's going to berate you for that. But all of us, but like, what the hell? Why am I in the Hungarian bonds?
So if you live in Hong Kong, what weight would you have in the U.S. market typically?
I think the U.S. does something like, I think the U.S. essentially has two things that you can't find anywhere else. Obviously, the one that everybody focuses on is tech, and the U.S. still has some world tech leaders. There's no doubt about that. And the other, really, I have a lot of U.S. energy names, and I have a lot of U.S. energy names because I'm a bull, I've mentioned, on commodities. I'm a bull on energy. And I find that the U.S. and Canada, in fairness, the two of them, are the one place where I feel pretty confident that my energy isn't going to get confiscated from me. That, if tomorrow the oil price goes to $150 because of whatever, the government isn't going to turn around and say, "We're confiscating all your profits." And I'm not as sure about that in Europe. I'm not as sure about that in Asia. I'm not as sure about that in most places. So, like, I'm not excited to own Procter and Gamble over Unilever, for example, and I'm not excited to own any healthcare stocks where the regulatory risk seems massive to me, etc. But there's two sectors where I think, if you want exposure to energy, so in my portfolio today, I have 25% energy, and it's pretty much entirely in North America. I own Ecopetrol in Colombia, but the rest of it is in North America.
Yeah, it's funny you said that, because I owned a Russian ETF for the energy play, and they compensate all the assets and went to zero. So I feel that pain. It was a ped in my cowboy account, of course.
Yep.
But I guess my question is, what's your view on energy prices, oil prices specifically? I know obviously we've had a spike here with turmoil in the Middle East.
I don't think we've had a spike. We're back to where we were April 1st. I mean, it's
fair point.
Like,
what's like your medium-term view though on oil prices? Higher, lower?
I'm a bull.
Range?
I'm a bull on energy because I think people underestimate the amount of demand that's going to be coming out of emerging markets, first and foremost. So I'm basically a bull on demand. I look at China. China, like we were mentioning, how China is exporting cars. 80% of China's car exports are internal combustion engine cars. China today is selling cars to people in Colombia and Pakistan. They're selling $8,000 cars to people who never had cars before. So it's not like people are replacing their VW with a BYD. They're all of a sudden getting a car.
And they're buying old school combustible engine cars, not EVs.
Exactly.
Incredible.
Because if you live in Pakistan, if you live in Colombia, the grid, the grid doesn't support your electric car. Not only that, but if you're a poor guy in Pakistan, like internal combustion engine car, if you maintain them well, can last 15 or 20 years. Electric cars last 5 years. So if you're a poor person, you're definitely buying an internal combustion engine car.
I think we're going to title this podcast "Short Tesla," by the way.
Sure.
If you're worried about them confiscating your oil, then maybe we should get you to buy one of these Trump gold cards, so you'll be completely covered.
Fair enough.
It's interesting. I had lunch with a client.
I personally don't need one. My wife is from Oklahoma.
Oh, there you go.
So I've got my backstop there. I don't need the $5 million card.
I had lunch with a client in New Jersey today, and they just told me that they got a notification from the motor vehicles division that you have to pay a $250 fee to own an electric car now. They make up for the gas taxes that they're not collecting because you're not
paying for the road.
You're not paying it. So what do you think that number is going to go to every year? You think it's going to go down?
No, like once you start a tax. Well, let me answer your question. I'll make like a Jesuit priest answer your question with another question. How often have you seen new taxes go down? Like they put in a new tax. Yeah.
We're eliminating.
It tends to go up. By the way, another thing on electric cars that people don't consider, they are much heavier and they have higher torque. So your wear and tear on the tires is actually much greater. Like if you're a Super Bowl on electric cars, you should be a Super Bowl on all the tire makers.
Cool.
But leaving that aside, so yeah, I am to answer your question. Look, I'm a bull. I've been a bull on energy and it hasn't worked, but I've been a bull on energy for demand side. But you also always have like the supply risk, and with everything happening in Iran right now, I'm a little surprised at how, to be honest, complacent the market seems to be that things will work out in the end. I mean, look, right now you have wars in the third and the seventh biggest oil producers in the world. And essentially the market is saying, yeah, don't worry about it. So I don't know. I do think there is a risk of a spike. But this is why I like owning my energy in North America, because my fear is if there's a spike tomorrow, the French government could tell Total, oh, you're making, inordinate profits. So I'm going to put a special tax because these are like, not correct profits. So I got to equilibrate that. I'm not saying this will happen, but I think the risk of that happening is also not zero. While I think the risk of that happening in the United States, especially with this administration, is very, very low.
Completely off the topic of finance, but if you could pick one album or song from your youth that totally changed your perspective of the world, what is that song or album and why?
Well, the first one that came to the problem is I grew up differently than you guys. I grew up in France. So I've got a song, but it's not going to tell anything to your listeners, but it's a song called by a guy called Nino Ferrer, who sang a song called Le Sud, the South, which is essentially, it's quite a melancholic song about how, how quickly a good life can unravel. And it's essentially a song about, France's time in Algeria and how quickly it unraveled. And it's, so I don't know, it left a marking impact on me on how things can go well. And then, just a few wrong turns and, somewhat what seemed like a stable equilibrium just goes complete pear-shaped.
Feels like a very French view of the world, by the way.
Yes, exactly. So, if you think things are good, it's about to turn bad.
Thanks for listening to The Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.